Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alti Global Inc. quarterly report. Alti Global Inc. offers a wide range of businesses and services that cater to the diverse needs of its clients. At the core of their offerings are wealth and asset management services provided across multiple countries, including France, Hong Kong, Italy, Portugal, Singapore, Switzerland, the United Kingdom, and the United States. The company's services include discretionary investment management, non-discretionary investment advisory services, trust services, family office and administrative services, and ancillary fund management services. Trust services involve creating or modifying trust instruments and acting as a fiduciary, while family office and administrative services encompass bookkeeping, back-office support, private foundation management, grant-making, and financial tracking. In addition to these core services, Alti Global Inc. also provides international real estate services, including real estate co-investment and fund management. The company's alternatives platform assists money managers in building their fund management businesses. Furthermore, the company offers clients estate and wealth planning, family governance and education, philanthropic and strategic services. Overall, Alti Global Inc.'s comprehensive range of services makes it a one-stop shop for individuals and families seeking expert guidance on managing their wealth and assets. Alti Global Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Alti Global Inc. trades at a higher price-to-book ratio of 1.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of key financial metrics. On the positive side, management/advisory fees have increased by $7,120 to $875, while distributions from investments have risen by $9,058. Additionally, other income/fees have seen an increase of $25. However, there are also several factors contributing to revenue decline. Incentive fees have declined significantly, dropping by -$89 or 100%. Furthermore, the timely collection of rents on underlying portfolio has decreased by 50%, resulting in a substantial loss of revenue. Higher interest rates and macroeconomic factors have also had a negative impact. Interestingly, management fees remain relatively stable due to high client retention rates. This stability provides a consistent source of revenue for the company. Nevertheless, potential future liabilities related to real estate products pose a significant risk, with a $3.6 million provision set aside for redress. Overall, these factors highlight the complex interplay between revenue growth and decline in this financial context. The net income of the company underwent significant changes over the period, with a notable increase of plus 304%, as reported on page 10. However, this figure is not an isolated instance, as similar increases were observed in subsequent periods, including plus 289% on page 12 and plus 106.3% on page 15. The net income continued to rise, albeit at a slower pace, with increments of 83% on page 24 and 71.4% on page 56. The profit margins, however, presented a mixed picture. While the net income margin increased by plus 207%, as reported on page 10, there was a decline in profit margins from $0.02 to $0.01 in continuing operations on page 11. The absence of direct information on profit margins change led to an inference that they likely increased due to the substantial jump in net income from continuing operations on page 15. The variable nature of performance and incentive fees significantly impacted the company's profit margins, as noted on page 53. This volatility is a key factor contributing to the fluctuations observed in the profit margins over the period. The adjusted EBITDA margin did experience an increase of 2.59% on page 56, providing some respite from the otherwise mixed trend. The incentive fees from the TIG arbitrage fund played a crucial role in driving the net income growth, as highlighted on page 53. This factor undoubtedly contributed to the significant increases observed in the company's net income over the period. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow of $5,311 as of March 31, 2026. This is a notable milestone, as it signifies that the company is now generating more cash than it is consuming through its day-to-day activities. This achievement can be attributed to various factors, including improved operational efficiency and effective management of resources. The positive operating cash flow also suggests that the company's financial position is becoming increasingly stable, allowing it to invest in growth initiatives and meet its obligations without relying on external financing. Overall, this development bodes well for the company's future prospects and provides a solid foundation for continued growth and success. The company's debt level has undergone significant fluctuations over the past year. Initially, it decreased substantially from $883,000 in December 2025 to $15,000 and $49,000 in March 2026. However, a closer look at other data reveals an increase from $883,000 to $14,920,000. Furthermore, the administrator's term loan increased from £11.2 million to $14.5 million. In terms of interest expenses, there has been a notable decrease from -$151,000 in March 2026 to -$89,000 in the same period. Conversely, another data point shows an increase from $0 to $14,000. The inconsistency in these figures highlights the need for further clarification on the company's financial situation. Management is optimistic about the company's outlook, citing plans to expand its global reach through strategic acquisitions. The company aims to provide clients with access to alternative investment opportunities, combining global presence with family office services. This expansion is expected to drive revenue growth and increase profitability through incentive fees. However, management also acknowledges potential risks that may impact the company's strategy. Ongoing investigations by the UK FCA could lead to financial penalties or other outcomes, which may negatively affect the company's outlook. Additionally, market fluctuations may cause a decline in revenue, and clients' asset holdings may change in response to changes in market risk. To mitigate these risks, management is focused on achieving specific investment performance targets and driving growth through acquisitions and strong portfolio performance. The company also expects sufficient cash and cash equivalents to meet normal operational needs over the next 12 months, although additional funds may be needed for new initiatives and growth acceleration. The company's financial activities have been transparent and consistent. On one hand, the company has demonstrated its commitment to rewarding shareholders by paying out dividends. This move not only boosts investor confidence, but also provides a tangible return on investment. On the other hand, the company has also taken steps to optimize its capital structure by buying back shares. By reducing the number of outstanding shares, the company aims to increase earnings per share and enhance shareholder value. There are currently no explicit concerns regarding inventory buildup or supply chain disruption. The only potential issue mentioned is the possibility of periods of low cash balances impacting capital availability for expansion. This could potentially lead to supply chain disruptions in the future, but it is not a current concern. That concludes the financial summary for Alti Global Inc. Feel free to comment below, and I will be happy to answer them when possible.